Good afternoon, everyone, and welcome to our latest stand-up webinar. My name is Warren Buhai. I'm a Senior Portfolio Manager in the multi-strategy franchise at Stanlib, and I'm thrilled to welcome you today, Stanlib's offshore partner at JP Morgan Asset Management, to give us an update of their recently released 27th Annual Long-Term Capital Market Assumptions. I'll take us through today the main drivers and investment themes underpinning their long-term forecasts. And in what has been a very difficult year for risk assets, as we all know, the one positive of that is that the repricing of many assets potentially improves the long-term outlook that they'll be taking us through. I look back at our webinar archives online, and I saw this is exactly a year ago that you actually welcomed John Bilton from JP Morgan Asset Management. And John had mentioned that their annual updates take 70-odd people over 9,000 research hours in covering around 200 asset classes. So a monumental effort by our core offshore partner, and I think you'll get a lot of value from the discussion today. But before we get going, I just wanted to give you a little bit of background around the practical relationship that we have with JP Morgan Asset Management. Originally, I went to London with our franchise head, Marius Oberholzer, to meet the multi-asset solutions team, including John and Thushka, in early February 2020, just before the COVID lockdowns. I can't actually believe it's almost 3 years now. And over the last couple of years, we've met them online every 2 weeks for discussions with the multi-asset solutions team. We've been responsible for managing a large portion of our offshore assets in our multi-strategy funds that we run for key clients of Stanlib. They produce high and consistent alpha over that period, which has been great for our clients. They've also presented their views in our internal quarterly TAA forums. So lots of interaction on the investment side, hugely beneficial to Stanlib and our wider investment platform from both a portfolio management perspective, investment insight, and new insights into risk mitigation, which has been crucial, especially in the more volatile times of this year. So joining us today is John Bilton again. John is the head of global multi-asset strategy at JP Morgan, been in the industry for almost 3 decades and based in London currently. And this year we'll also be joined by Thushka Maharaj, who's a global strategist in the multi-asset solutions team, now based in Paris, but very importantly, originally from South Africa. And we are very proud of her exceptional career so far. John and Thushka will take us through their slides for around 30 minutes, and then we'll move to the Q&A. So please post any questions that you have in the Q&A box. And just another reminder that please stay online for the full hour to gain your CPD points. So with that, I'd like to welcome Thushka and John online, and thank you very much, guys, for joining us today.
Hello, there we go. Brilliant. Okay, transatlantic technology, it does seem, can be made to work. So thank you, everybody. Apologies for that slight technical glitch at the beginning. As I mentioned, I'm joining this call from our offices in Midtown in New York City. So, although I think we're glad to see the back end of the pandemic in many regards, I think one thing which has become clear is just how much smaller the world has become now that we've got this ubiquitous use of technology. So I hope that by being able to link up 3 continents, the Americas, Europe and Africa, we'll be able to have an amazing conversation today, talk about what's been going on this year, to think about what 2023 might look like, but also, most importantly, to think a little bit more about the longer term. This has been really quite a year, I think is the best way to describe it. And in fairness, this has been a year where we've not seen, the type of market volatility in equities, at least, that we might normally associate with the type of drawdown that we saw, 25% from top to tail in S&P. But my goodness, it's been quite a move in the bond markets. So what I'm going to do is spend about 10 minutes now talking through, a little bit in terms of 2023, what we're thinking about the long term, and then I'm going to pass it to Thushka to talk about the macro environment and the fixed income environment over the next sort of 10 years or so. And then I'm going to come back on, talk a little bit about equities and about alternatives. We're going to take about half an hour, 35 minutes all told, and then we'd love to open this up for questions. So if we can go to the next slide. Thank you. So what has characterized 2022? Well, very simply, the fastest pace of Federal Reserve tightening that we've ever seen in recent financial times. There were a couple of slightly sharper rate hiking cycles back in the 1970s. But when we think about the post-Volcker era, This has been by far the quickest pace of hikes we've seen. And once we see the outcome of the next couple of hiking rounds, it's very likely to be the largest set of hikes that we've seen on record. Now, what seems to be driving quite a lot of volatility at the moment, and certainly are giving markets a little bit of relief over October and into November, has been the notion, if you look on the right-hand chart, that the Fed are going to get to their terminal rate and then turn things around very quickly. But the thing is, with inflation still high, and as we saw a pretty hot employment print on Friday last week, the idea that we get a pivot may be wide of the mark. In fact, a pause, a slowdown in terms of hiking, but then a prolonged period of relatively high policy rates is much more likely in our view. So what does this mean for markets? Well, if you go to the next page, please. This has been really quite an unprecedented year. If you look at this chart, this is the 60-40 stock bond portfolio, global equities, global bonds in US dollars. And you can see that on the green dot, this is the worst drawdown we've had since the financial crisis. But unusually, if you look at the blue bars, the dark and light blue bars, actually this time around, bonds got in on the act. And they were as responsible as stocks were, really, for pushing returns down over the course of the year. And then the eagle-eyed among you will notice that those dark blue bars, the bond markets, this has actually been an unprecedented year. This is the first time in history we've seen back-to-back declines in the total return for global bonds. It really has been quite an extraordinary year. So where do we see 2023 shaping out from this interesting starting point? Well, if you go to the next page, we're still in a somewhat cautious tone when we think tactically. If we think out over the next 6 to 9 months, global growth is likely to be sub-trend. We are seeing some signs that China could begin to look better. The US is kind of a coin flip on whether we get a recession. Europe and the UK probably in one already. Policy, as mentioned, it's a pause, not a pivot. So that means that at some point during the first half of next year, it's highly likely that we will see real short-term interest rates actually move into positive territory. And that means that you've got some lingering support for the dollar, but we think that the global growth picture, as we move through a period of sub-trend growth, will start to price off of the forward as we go through the year. And we do think that the dollar is beginning to sort of show some signs of turning around. It certainly has given up a decent amount of value lately. Trade, we think, it's a bit of a headwind, no doubt about it. But China moving on from zero COVID does give us a little bit of support. The one thing we're still concerned about for 23, though, is earnings likely to decline. Even if margins can stay high, make no mistake, slowing nominal growth is going to create a problem for top lines. For choice, we'd see earnings coming roughly flat to full year 21 in S&P 500, which means giving up still some ground from where forward earnings expectations are today. And that likely means that stocks have some headwinds in the first half of next year. And energy and commodity markets, as we know, they remain quite tight. We've seen some gas prices spiking in Europe. So a lot of the issues that have really hurt markets this year are fading, but only slowly. But crucially, as we look a bit further forward, actually, the backdrop starts to clear a good deal. So tactical caution, certainly, but we're beginning to become more opportunistic. And the reason for that, if we can go forward a slide, is because we do believe that this year has really reset the clock in terms of long-term asset market returns. Let me take you through some numbers. If we go to the next slide, please. So for all that slightly dour warning about some concerns in the first half of next year that we need to work through, make no mistake, this is the best opportunity that we've seen for long-term investors in a decade. So in fact, since 2010 in US dollars. The 60-40 return forecast has leapt nearly 300 basis points, which means that that magic 7% number, which so many investors really see as a benchmark, is possible once again. Bonds this year, because of the reset, are offering more than stocks were last year. And these are, just for point of clarity, these are annualized 10-year projections. It's the average return expectation we expect over the next 10 years. It's not a point number for next year or the year after, it's that average. But stocks themselves, yes, we're a bit cautious, but it's not lost on us that with equities where they are today, return expectations have picked up. it takes roughly half the time to double your money in equities compared with our forecast last year. Why is that? Because we front-loaded the losses. It's really that simple. So the longer-term return outlook is much cleaner, much clearer today. And alts are still offering good diversification. We'll talk about that a little bit toward the end. If we can go to the next slide, please. Just want to sort of raise the obvious question, which is, well, that's great for you guys to say that it's a good-looking outlook for the next 10 years, but why should we listen? Well, this chart shows you the way in which these returns have performed over time. The blue bars are our forecasts. The orange bars represent the subsequent 10-year average annualized return, and this for 60-40. Out to 2014, we've got full data sets. 2014 to 2018, we've got at least half of the data in. After 2018, we don't really include that in our analysis. It's just there for completeness. But if I look at the period 02 to 2018, over 70% of the time, our forecasts were within half a standard deviation of the subsequent 10-year annualized returns. So when we say we eat our own cooking, we're doing it from a basis that we have an institutional framework which draws on the expertise right across JP Morgan to hopefully provide stable and robust long-term forecasts. On the next page, please. We use it very much within our books of business. Thushka and I are both privileged to sit within the multi-asset solutions business, where we have partnerships around the globe, and we look after $250 billion of our clients' money. And to do that, we need to use a long-term strategic allocation approach, and we use our long-term capital market assumptions to support this. We really do, to use a very British expression, eat our own cooking. If you go to the next page, then you can see across our books of business, it's central to what we do. Every portfolio that we run relies on these numbers. So when we have these conversations with clients, it's not just marketing, it's not just forward ideas that hopefully that may or may not come to pass. We are very much in the same camp as everybody else in terms of using these numbers to run portfolios ourselves. So let's move forward to the next slide. And this really highlights why we think that this year is such an interesting point. Yes, 2023 will start with some of the lingering issues we saw in 2022, and we certainly urge caution. But when we look at our long-term capital market assumptions, we separate them out into secular drivers of return and cyclical. Secular return drivers are those returns that we would expect to be able to achieve in the event we could buy the market at fair valuations, fair margins, fair yields. And then the cyclical piece really is the normalization or the move back to par. And what you'll see from the blue bars here is that the secular returns are pretty stable in most asset classes. Indeed, within high yield bonds, because of improving credit quality, actually they've picked up. This is not a broken asset market. This is not 2008 where the banks were broken, nor 2010 through 12, where certain countries in Europe came close to going bankrupt. Instead, this is a market where the entry price has moved, where what we've seen is long-standing dislocations have really closed up, relating mostly to policy rates and to valuations. And this creates in our mind a much more positive backdrop for being able to think about asset markets over the long term, rather than having to think about asset markets in terms of short-term policy, short-term movements of central banks, and thinking about it from that angle. This is an opportunity to start thinking about those long-term portfolio objectives once again. Now, what I'd like to do, if I may, is pass over to Thushka, who's going to take us through the economics and answer the question as to why is it that those asset market returns, those secular returns, are actually surprisingly stable. Thushka, let me pass to you.
Thanks, John. And thanks for having me on the call. I'm very, very happy to be here. And as John said, I'll speak through the macro assumptions and what these mean for our fixed income returns. So starting with those macro numbers on this slide, we keep our growth, our long-term potential, real growth estimates fairly stable. You can see that on the slide where we show the components that make up our growth forecasts. And as these are long-term forecasts, we use the key inputs that are the natural inputs for developing long-term growth forecasts, your labor inputs, your population adjusted for labor participation, capital growth and capital deepening, as well as productivity. And on the right-hand side there, you can see these components for our major markets. They are fairly stable on a long-term basis. So to John's earlier point, when we're looking at secular return expectations, they are built of these long-term growth forecasts. And in real terms, our growth estimates are hardly changed. Our US growth, for example, at 1.6% on average over the next 10 years is slightly lower than last year, 10 basis points lower. So these are the developed market expectations. We have the same input framework and building block approach for our emerging market forecasts as well. And so essentially that picture for long-term growth is fairly stable. But what you can see on the left-hand side, what is modestly different this year is that forecast for the mix of real versus inflation contributions to nominal GDP. So what we're showing on the bar chart is essentially the components of real growth on a global basis plus inflation, and the green line shows the contribution coming from inflation to nominal GDP. And essentially it's that contribution from inflation that's moving higher, or at least been consistently moving up since over the last few years. It's not a terrible mix of growth coming from inflation and real policy, or real growth, but the increase from inflation is a notable trend. Now, our inflation forecasts, if we move to the next page, we'll walk through some of our rationale. If we could, yeah, thank you. If we could look at this slide, we've modestly upgraded our inflation forecasts. So we're going, in our view, from a regime of very low inflation to a regime of slightly higher inflation. And we see the risks as being more two-way around inflation rather than only downside risks on inflation over the next 10 years. Now, I know this is very topical, both from a cyclical basis, but also from a secular basis. And so we can walk through why on a long-term basis, we are still in the camp of inflation, yes, rising modestly, but not entering a 1970s style stagflationary type of environment. And what we did on this page, for example, is outline what we see as the secular forces driving inflation and comparing it to what we've experienced post the financial crisis. And what you can see on this page, looking over the last 10 years, the 10 years before the COVID recession, we had many downward factors on inflation, whether that was globalization, union membership declining, forcing down wage pressures and forcing down inflation, whether that's technology adaptation. All of these factors more on the downside. But as we look over the next 10 to 15 years, we are seeing more two-way risks, more risks both to the upside, but equally headwinds to inflation persisting over the next 10 years. Now, where do these topside risks come from? Income redistribution. We're seeing more policies that move more towards income redistributive type policies on a fiscal basis. Globalization, which we see as having peaked, but not necessarily disappearing in the near term, being inflationary as you see more nearshoring or onshoring, as well as components coming from ESG. So the idea that in the near term, we will see green inflation or inflation that's needed in order to make the transition to a cleaner and a greener economy. So we do see more topside risks in the near term, but crucially, those downward factors for us still persist, whether that's technology adoption, online price availability, and basically more symmetry in price availability for consumers over the next 10 years, weighing down on inflation. So where that leaves us is essentially a modest upgrade to our US inflation forecasts. It's moving to 2.6% higher by 30 basis points. So that's on average over the next 10 years. And it leaves us with a view that, yes, inflation will have more two-way risks and be more volatile, but we are not in the of the view that we will see a persistent wage price spiral that forces inflation to continue rising upwards over the forecast horizon. But let me point to that volatility of inflation, because this is a crucial point when we build our capital market return assumptions. If our inflation assumptions are becoming more volatile, for example, a 40% increase in our euro area inflation forecasts. A 40% increase. This is the first time we've actually moved these inflation measures higher in the last 8 years. That filters across the capital stack, moving into our cash return numbers, which then goes into our fixed income and so on, and filters, reverberates across the entire capital stack. So volatility measures have by definition moved higher this year. At the same time, when you are seeing central banks, and our central case is that central banks will be removing liquidity from markets and from economies over the next 10 years. At the same time that's happening, the need for capital investment is also rising, whether that's because of ESG adoption, whether that is because of the move away from globalization and the need for resilience in supply chains. So basically we have central banks removing liquidity, the need for CapEx rising, and interest rates or the cost of financing rising at the same time. What this means for us is that essentially markets will have to return to their more normal function of having to allocate more efficiently in markets, basically creating more dispersion across returns. So higher inflation volatility, higher macro volatility for us translates into more dispersion or more an increased opportunity set for harvesting dispersed returns across asset classes, a strong contrast to what we've had over the last 10 years. So inflation for us, yes, it's rising, more two-way risks and more volatile. How does this impact our return numbers? On the next page, you will see, if we move to the next slide, you will see our fixed income return expectations. Just to put that in context, John mentioned this at the start, the left-hand side shows the drawdowns we've had in fixed income markets. Essentially, the largest drawdown in the US Bloomberg Treasury Index since its history, or since the start or inception, in nominal terms, and in real terms, the most severe drawdown that we've had since the Volcker era. So severe drawdowns, yes, it's been a very painful year, but when we look over the forecast horizon of the next 10 years, this creates a very interesting opportunity for us as investors. So when we look at our return numbers on the right-hand side, those numbers you can see on there, return expectations, for example, for the US 10-year Treasury at 4%. That again is the highest we've had since the financial crisis, so 2009. But it's actually crucially now positive in real terms. So once we adjust for our inflation forecasts, looking across the fixed income spectrum, you can see compared to last year, the light gray bars there, a much higher return expectation. And that's largely coming from starting points. So you can see our starting point when we took our cut for LTCMAs was at 3.8% versus last year, which was less than half of that at 1.45. So essentially that starting point, seeing yields rising, gives us a much more attractive opportunity over the medium term. I will also mention and sort of pause here by saying that this is also from a cyclical basis, the area that's attracting a lot of our own interest, where we see the cyclical and the secular views aligned, being positive on US fixed income at this stage. I'll pause there and pass back to John.
Thank you, Thushka. So what I'd like to do then over the next sort of few minutes now is just go through equities, think about alternatives a little bit, and then come back to just thinking about the portfolio context and what we're thinking about when we start to refocus on the long-term outlooks in our portfolios. Thank you for moving the slide. So within equities, I think the first point to make is that a lot of what we've seen this year has been a re-rating move. Now, the chart on the left really shows you what's gone on. We've seen a significant drop in valuations, and this is global equities in their PE terms. And it's actually quite profound when we look at it across the global equity market. We can see that the stock market now is as cheap as it was back in the financial crisis and indeed in the Eurozone crisis. So that's a significant reset of valuations that's perhaps been long overdue. The US continues to be at the sort of more expensive end, places like the UK still at the cheaper end, and China in particular has been discounted a long way. But by and large, it's this move that has pushed up the numbers. About 75% of the move in terms of our forward expectations is related really to just the cheapening up. So as mentioned, this is not an asset market that has necessarily seen the underlying cash flows or dividend streams or growth opportunities really change that much. It's one where, frankly, some of the overstated level of valuation, which in turn was linked to artificially low policy rates, has now unwound. Now, in the near term, of course, when we think about earnings, there's probably a little bit of headwind to think about for 2023, as we mentioned. But if we build up on a long-term picture of the market, where we think about trend economic growth that Thushka mentioned is fairly stable, we think about margins, which, although they're a bit high today, and probably are still a headwind to the tune of perhaps 100 basis points or so on a long-term return expectation, we don't expect them to necessarily mean revert down to the very low levels that we saw 25 years ago. The sector mix has changed. The capital structure has also changed. So a slightly more rosy picture on margins and a slightly higher equilibrium level is also adding about 10–15% of the cheapening that we've seen in equities. And then finally, the improvement in return has also coming in part from rethinking share count. Because one of the things that we've noticed is as the equity markets have matured, we're seeing just a slower pace of gross dilution, which means that there's less of a headwind as companies list in markets. These are much more mature markets now around the globe. So we bolt back together our sustainable growth rate model. The returns really have picked up very profoundly. US large cap in particular, and these numbers all in US dollars on the right-hand side, has jumped from 410 to 790. It's almost doubled. And a lot of that really has come down to the cheapening. Europe, Japan, other developed markets outside of the US actually look very attractive to a US dollar-based investor. And the reason for that is that we get around a 200 basis point additional pickup because the dollar itself today is relatively rich. And we think that over the course of the next few years, we will see the dollar begin to decline. Now, it's not going to go in a straight line as we model within these numbers. We're assuming about 200 basis points a year of potential boost. It's more likely to happen in fits and starts. But certainly anyone investing with a US dollar-based currency is going to find that there are much more attractive areas to invest in the equity markets in particular, across Europe, across Japan, and of course, across the emerging world. You'll see from that lower line that in US dollars, China really has been the laggard for much of the past couple of years. And it's the only major market globally where there's not a margin headwind anymore. So across the board, we believe that there's a lot of opportunity opening up in equities. It may be for some a little bit too soon to be thinking about rebuilding equity positions over the long term because of the points mentioned earlier about that earnings, that potential for earnings decline in the short term. But make no mistake, we think we're moving on very profoundly from a world where we want to sell the rallies to one where potentially we want to be accumulating on weakness. So there's lots to do in fixed income, as Thushka mentioned. So for the more risk averse, there's plenty to think about in terms of adding risk there. But then don't ignore the fact that equity markets are now offering an extremely interesting entry point. If we go to the next page, I just want to say a word on the alternatives world. The chart on the left you'll see is a stock bond frontier. It's going from 100% bonds to 100% global equities. And it's the risk and reward in volatility and expected return terms on the two axes. Last year, the orange line showed that we were seeing very, very low expected returns regardless of risk profile. This year, the blue line shows that that's jumped significantly. The dots you'll see in the middle are the alternative asset markets. And if you look at the orange colored dots and the orange line, you'll see that last year, the alternatives market sat generally very much above what public markets could offer. So last year, alternatives was very much a top-down decision. It was the place we could find returns. This year, however, you'll see that the blue dots have, in some cases, now sit below the line. Certainly real assets, real estate, transportation, infrastructure, they've not really moved. And in large part, that's because they've been somewhat immune to this year's gyrations in public markets. They've actually proven to be very diversifying. When we look at it today, the thinking about alternatives is much more about a bottom-up decision. Where can we add diversification? Where can we add some inflation protection? But more importantly, where can we think about alpha? And the chart on the right-hand side shows you the spread of alpha that exists within, in this case, the private equity markets, but it exists in all alternative asset classes. When we think about our efficient frontiers, we're solving for a median manager. But those who have the skill and the opportunity to select upper tier managers can add a significant boost over and above that median manager return. So this year, alternatives also are back to basics. They're back to doing what they should do, about being a bottom-up investment opportunity. And certainly, as Thushka mentioned, with markets being more volatile, policy, potentially moving back to a more normal range, and markets actually having to allocate capital efficiently rather than simply funnel central bank financing. That means there's more for active managers to swing for. And the alternatives markets are particularly a good place to be looking for this kind of active pickup. So really, moving from top down to bottom up is the way we think about alternatives this year. But if we move to the next page, and the final one, where I'll just say a few words on before we go to Q&A. Once again, on the left-hand side, so these are those stock bond frontiers once again. But here, what I've done is added a further line, the grey line, and that's where we were in 2008. What we can see is, by and large, the returns across the risk-reward spectrum have picked up to within touching distance of where we were coming out of the financial crisis. Now, that's quite a significant statement to make, because coming out of the financial crisis, we knew that we had significant problems with the banking infrastructure. Today, we feel more confident about underlying assets. There is obviously always a trade-off, though. What you'll notice from those boxes on the lines, the orange blob, the blue one and the grey one, that's the 60-40 portfolio. And it has moved up in risk terms. It's moved horizontally along the x-axis. So for the Sharpe ratios available are not as great as they were back immediately after the financial crisis. Returns have picked up, but we do need to actually deploy a bit more risk to access those returns. And that means that while we've got much better returns on the face of it, we need to continue to think about diversification. We need to continue to think about having the full toolkit of assets available to us, and thinking about how we can boost the resilience of that capital market line, whether it be to add returns or whether it be to be able to use diversification to give us the same return for a lower unit of risk. But the real takeaway here is we have changed regime, not from low to high inflation, as some in the media have posited, but really from the end of free money to a world where markets are having to once again allocate capital efficiently, which means for us as investors, there's more reward, there's more opportunity, and more ability to be able to sort of seek out and think about active management. The one thing that we would also add on this case is that we've not moved from low to high inflation, but from lower to higher volatility. And that's really reflected in these risk terms on this portfolio page. But above all else, having the full toolkit available, seeing 2022 for what it was, which was a reset as opposed to necessarily a degradation in terms of assets, really sets us up to be thinking about the long-term success of portfolios. For sure, we have to think about some residual volatility and some concerns still to be ironed out in 2023. But this is the first time, certainly in a year, that we feel that we can, with some confidence, begin to look at those long-term portfolio goals and be thinking about those long-term outcomes for our savings and investments. So with that, let me pause. I think it's time for us to be able to go on to Q&A. And so I'll hand it back to Warren to lead us through that.
Great. Thanks a lot, John. And thanks, Thushka. It was very interesting. And I'm happy to see, John, there's a lot more positive message for the long term than it was last year this time. I'll start at the higher level here with the questions and then move down to more macro. To start, with the ever-increasing involvement of fiscal and monetary policy that we're seeing now, and I think, John, you started to speak about this on your last slide, about how difficult the environment is, but have your conviction levels changed at all in both, relying on these longer-term forecasts, even though you've got a very good track record, as you showed, or indeed in establishing the asset allocations you look to for your clients in meeting their goals?
Yeah, I think that's a good question. So by definition, if we think about it mechanically, if we increase the volatility of our assumptions, we widen the confidence band on it. It's a mechanical sort of process. It also goes back to, I certainly can remember the words ringing out during Finance 101 when I had a lot less grey hair, which told me, don't think about uncertainty by reducing your return assumption, because if you're wrong, you just compound it up, especially when you're looking at long-term numbers. If you want to think about a more uncertain environment, hit the risk side. And that's what we've done. We have acknowledged, and you'll see that with the 60-40 portfolio, the vol number there, that has pushed up. It's around 2 vol points higher than it was for similar level of return back in 2008. So that reflects we have to acknowledge more uncertainty around policy. And as Thushka mentioned, the volatility of inflation has picked up by 40%. It's a small number, to be clear. In US terms, it's gone from 1.1 to 1.6. Doesn't sound like much, but again, to repeat Thushka's point, it's the base of the asset stack. If that moves, everything else goes with it. And finally, of course, we've had to think about correlation. And when we think about that, actually the ability for stocks and bonds to be inversely correlated, we still think that holds, but it has decayed some. This year, our correlation between global equities, MSCI ACWI, and US aggregate bonds has gone from -0.22 to -0.06. Still negative, but not giving you quite that same base of diversification, which is hence why we need to think about all the levers we can pull as investors to really make sure that we build the most robust portfolios we can.
Great, thanks, John. A question from Eugene. How do you see the asset mix change over the next 10 years versus the previous 10, notably due to the increase of risk premium that you talk about?
Well, I'm going to bring Thushka in on this one in a moment, particularly with regard to bonds, because I think mechanically, the risk stack has moved up more or less in lockstep. So from last year's numbers to this year's numbers, we can just achieve more from liquid markets. At the margin, there is a lot more sort of interest, we think, in fixed income, largely because the equity risk premium has actually compressed. Despite equity returns going up, we're in a world where when we look shorter term, those earnings yields are not looking as attractive as they might. And until we fully reset that, I think that'll keep some on the sidelines with regards to stocks. So I think the real change against the long run is bonds are back in business, and it doesn't take a covariance matrix to tell you that a negative yielding bond isn't going to do you much good in your portfolio. So the reality is that I think that's come back I would say has come roaring back. We weren't expecting bonds to reset their pricing in just 9 months. We'd expected it to be 2 or 3 years. So it's really opened that up. But Thushka, do you want to pick up in terms of what we're doing more tactically as well?
Sure, John. Just to underline that point in terms of the year-on-year change for portfolio construction, a parallel shift higher in our stock bond frontier is not something, we haven't seen that for multiple years. We've had pivots where you'd see equity returns go up and down, but actually to see the fixed income returns to rise as meaningfully, it is the first time since the financial crisis. So on a structural basis, buying more fixed income and core duration, so US treasuries and global government bonds in developed markets is a meaningful change. But to John's point, this is the one area in fixed income where we're seeing an alignment across our cyclical outlook as well as our structural outlook, Warren. So to this point that in the near term, over the next few months, we are likely to be increasing our allocation to core fixed income, essentially as we see the markets price in a terminal rate both in the US and Europe. But secondly, the thesis that you can now actually earn income once again in fixed income. So not just looking at the total return, but actually looking at being paid to have that income back in your fixed income or your safe portion of your portfolio is something that we are looking at.
Great, thanks. And just related to that, Thushka, is there this element with a high correlation between equities and bonds, and we started to see it again in the very recent past? What informs your view that kind of will go negative, as you say, not as negative as we've seen historically, but that it will go negative again, and kind of the time horizon you see getting back to that negative correlation?
Sure. Yeah, this is a fundamental question for us in multi-asset solutions. Where does this correlation head to in the sort of near term, medium term, and long term? And one thing we did in the LTCMA publication in our volatility paper was looked at a scenario analysis. So say if the current environment of positive correlation or close to zero correlation persists, how long would it need to persist for in order to move our long-term estimates into positive territory? So how long would we need to see the current environment play for in order to change structurally move correlation from negative to positive? And it was 2.5 years for the US. So the US stock bond correlation. So we need to see the current period persist for that. So the question is, what's our view on that likelihood of it persisting over that period? One, it comes to our conviction on where we're expecting inflation to head over the next 12 months. We're still expecting persistent inflation pressure, but the direction of travel, the delta or the rate of change, we'd see as being more moving inflation lower. So a more positive view there, expecting inflation to gradually fall back to targets. What I would say, though, is that given the higher volatility of inflation, and therefore the higher uncertainty around where that correlation goes, this does affect the sizing of positions. To your question, Warren, over the near term, we are fairly confident that inflation over the medium term will be brought back to central bank targets without central banks having to adjust them meaningfully higher. But at the same time, we're very conscious about the two-way risks around inflation. So that affects both the volatility and the risk sort of sizing of positions over the medium term. I'll pause there. John, anything else you want to add?
No, I think that more or less captures it. It's just recognizing that although these do look like rosy numbers, and indeed they are, best in a decade at least, there's always a trade-off in finance, which whether we like it or not. And that higher volatility and slightly higher correlation is one that we do need to keep very close to top of mind.
Great. And just on the inflation part, there's been a few questions around that. So the one is around, do you ever see it going below 2%? And I understand, Thushka, your point about getting back to central bank targets just maybe over a longer period. And the other one is, given the macro drivers that you show, that half of them seem to have changed to more positive, looking forward to the past, is kind of the smaller tick up that you've had in your longer term forecast for inflation. How confident are you in that, or is there a risk that it goes above, in the US, for example, above the 2.6% and materially above that, at least in the shorter term, the next few years, as opposed to 10 to 15 years?
Yeah, to that second question, Warren, absolutely. There is a risk to the top side on inflation. If we do start seeing hard data telling us, that nearshoring is actually more inflationary rather than productive, that would be one sign that's telling us that inflation can persist for longer. Secondly, these factors that are moving inflation lower, like technology adoption or union membership, for example, which is quite topical at the moment. If you start seeing a change on that front that we would consider structural, that would pose upside risks to inflation. I would agree with you, if I had to look at the distribution of risks over obviously the next 2 or 3 years, they're more on the upside than they are on the downside. I think what we wanted to highlight on that slide is, don't forget these structural factors that have existed and are likely to persist over the medium term.
Okay.
If I can jump in on that as well, just to make sure that we qualify the numbers properly. Remember, we are putting all of our inflation numbers around the globe in CPI terms. The Fed solve for PCE. And that has about a 30 basis point basis to it. So the actual 2.6 is nearer 2.3 for the Fed's targeting purposes. So I agree with Thushka, it's the distribution of risks. And most of that uplift this year comes from us expecting inflation to decay back down to and probably through target over a couple of years, given the efforts the Fed have made so far, and noting that the impact on prevailing inflation tends to operate with a 3 to 4 quarter lag. So short answer, do we expect the inflation ever to be below the Fed's target? Yes, by definition, because of that higher level of volatility around an equilibrium level, which is not far detached from where the Fed's target is today.
Yeah, fair enough. Thanks, John. Just related to this issue, Thushka, that you raised around, the technological impact potential on inflation as one of the structural drivers. If we just switch it to GDP, how big would you say the upside risk is on your GDP growth forecast? You've got the productivity factor there. We always hear about how the world's going to change from new technologies and why some of these companies have been priced like they have been, even though we've seen that correct a lot in the last year. Is there a material upside risk to GDP if the productivity gains come through, like some of the technology companies are claiming?
Yeah, thank you. Thank you, Warren, for once a question that's taking us away from pure inflation. I appreciate it. A slide that we didn't put in this deck is we are pretty positive on productivity over the medium term. Because of your point about technology adoption. We had a theme paper in the LTCMAs, I want to say 3 to 4 years ago, that looked at the top-down impact of technology adoption on our productivity numbers. And I would say on a global basis that posed an upside risk of about 2% of global GDP. So it could be meaningful. But let me tell you about what we have for productivity forecast, because we are actually on the positive side for that. I just have the numbers in front of me because I prefer talking about that upside risk rather than the inflation upside risk. Over the last 25 years, productivity growth in the US labor productivity was 2%. The last 10 years, about 1.3%. So we've had, since the financial crisis, a downtrend in productivity growth. What we're forecasting over the next 10 years is something in between those two. At 1.6% for the US, we're basically saying we're going back to some average of what we had pre-financial crisis and post, saying that we will return to the era before the financial crisis. And it's worth noting that we've very recently, in the last few quarters, seen an uptick higher in the realized productivity numbers. US, Canada, and Australia, all of these economies post the COVID pandemic, we've seen an improvement in productivity growth across these markets. And we're basically saying that trend will continue, essentially post a balance sheet type recession in the financial crisis and the impairment of balance sheets there that impaired the growth of productivity. And we are saying essentially, once we've had that healing, we'll see an improvement in productivity as well. So again, another factor for us that can offset this inflation question as too.
Thanks, Thushka. And just related to that, there is a question: will deglobalization not drag down productivity in your mind?
Yeah, that is the follow-on. As you can see, we do have deglobalization being a positive factor on inflation. So what does it do on the productivity side of that equation? Open question. I would say that we on the optimistic side, Warren, that the increased need for capital spending, this move away from pure globalization increases the need for capital spending, which has the ability to create more productive capacity. Whether it does or doesn't, we will yet to determine. But the nearshoring we would expect to be mostly technology driven, and therefore we'd see that at least in local terms being more productivity enhancing. But I will note though that at the same time in this paper on deglobalization we have in this year's LTCMAs, it does talk about a more multipolar environment, so moving away from pure globalization to a multipolar environment where we are seeing more global trade in not pure goods, but more services. And that's the part where we'd expect productivity to be higher. The only final point I'd make is the last time we had multipolar worlds, this increased international competition was during the Cold War. And that led to innovation in nuclear energy, for example. So we have one example. I don't want to extrapolate that too far, but we do have examples where competition or instead of cooperation has led to enhanced productivity growth.
Yeah, if I could jump in on that as well, Thushka, because I think we've got to see globalization for what it is. If you run it in reverse, the fact of the matter is what nearshoring does is it moves you back down the value chain, which means that typically your gross value add or for any sort of activity tends to go down. So it has a degree of adverse productivity, but at the same time, think about the other side of it. We've got a number of challenges as a planet, not least climate change. which requires deploying huge capex, $130 trillion estimated in the COP26 and 27 as the cost or the investment needed to get us carbon neutral by 2050. And that's money that's committed. Capex leads productivity growth. Not all capex is made equal. So to Thushka's point, if deglobalization just means a bit more polarization of supply chains, then there will, and duplication of supply chains, then there will be a productivity hit. But by and large, when we think about bringing, think about where we go in terms of development of infrastructure for renewables, sustainability, etc., that requires investment. We also should think about the labor force, and there's another paper within this year's LTCMAs on how we're working towards a 10 billion person planet. So by the end of 2100, we're expecting, Tanzania is going to be in the top 10 most populous nations, as is DR Congo and Egypt. Nigeria's population will have quadrupled. At the same time, China's population will be down by a quarter and Italy's by a third. Now, that is a global workforce which we need globally. And as we see investment in labor and in services, we think that some of these regions potentially have got a big pickup in terms of productivity, opportunity to really see, parts of the frontier and emerging economies really begin to take a bigger and bigger role on the global stage. So it's not the question of globalization going into reverse. It's a reset. It's moving away from goods globalization towards labor and services and opening up new markets and economies. And that's actually pretty positive from the point of view of generating productivity, but also answering the issue that we face if we look at the global labor force of dealing with the aging population that's obviously been so much in the press over the last 10 to 15 years. And so when I think about globalization, if we look longer term, I actually still think it's a positive force and one that can add productivity, but we just got to think about it differently.
Great, thanks. We are running out of time quickly, but before I get to the shorter term questions, as you can imagine, there's some about the shorter term market views. Just your view on China, are you getting more or less negative on the China fundamentals over the next decade? We obviously know the demographic issues, but holistically, are you getting more or less negative?
I think we've got to treat China as being, as we've said for many, many years, I mean, trying to take a US or European model and apply it to China means you're going to get the answer wrong. China very much will develop their own sort of economic model. They have their own governance model, some elements of which may be less or less palatable for international observers, but be that as it may. I think a couple of things I would point to. Firstly, the commitment that China had made back during their 5-year Congress back in October, which is they reaffirmed their interest in collective prosperity. To have collective prosperity, you do need a private sector. You need to have employment as close to full as possible. You also need to invest in services, particularly for China, where the population is aging rapidly now. You need to think about financial infrastructure, services infrastructure, healthcare. So I would say that for China, there are good reasons to want to be investing alongside China. But make no mistake, China want to control their sphere of influence. So assuming that they will welcome every dollar or euro or Swiss franc or rand that goes their way may be wide of the mark. Co-investing for their own aims may be something that's more plausible. Investing in something which is frankly a stepping stone, perhaps less so. And then, of course, as we know, there is more geopolitical risk. China are keen to sort of protect their sphere of influence and have been more muscular in their rhetoric of late. So I don't want to. I'm not a geopolitical strategist, so I'll stop short on that one. But certainly the risks themselves are higher than they were. So I think we just have to remember China is not a economy that's going to end up looking like the US or the Eurozone. It's going to form its own, it's going to plow its own furrow.
Fair enough. Thanks, John. Just as I mentioned in the shorter term, I'm just going to combine a few questions here because there does seem to be a lot of concern around, especially the first half of next year, saying a lot of commentators are talking about market correction, earnings downgrades, and actual earnings falls. How worried should we be about declining global equities and especially earnings in the next 6 to 12 months?
Well, just I think first and foremost, if nominal growth comes down, It was running in the US at 8-9% this year. We're running next year, we think, maybe nearer 4 over the full year, 4.5, which is made up of a pretty anemic level of real growth, somewhere around 100 basis points, with the rest coming from average inflation through the year. So if you're halving your nominal growth, you're going to hit the revenue number. So even if margins hold up, that's tougher. I think the mix we've seen is there's still a relatively hot labor market in the US, which puts some potential cost pressure onto corporations who will perhaps run out of the ability to pass those costs on. So we've got quite a unique mix. Now, it's a bit of a coin flip as to whether the US falls into recession. There are forward-looking indicators like Senior Loan Officer Survey, which suggests weakness, other ones like the labor market, which suggest actually some strength. So, I think it is a little bit of a coin flip there, but I think earnings, if we enter a recession, it's only then that you'd expect a realized earnings decline, at which point you'd be expecting maybe 15-20% out of earnings, putting S&P 500 earnings maybe 180, 190 for the year. If the US moves through next year avoiding a recession, then taking some of the steam out of earnings, taking it down maybe to the sort of 205, 210 level, which is flat to full year 21, would be probably more plausible. Bear in mind, outside of recessions, delivered earnings don't tend to come down aggressively. Companies use quite a lot of financial engineering to hold them up, but their guidance comes down. And there is one final thing to recognize. Corporations don't tend to really guide down until they can see the end of the down cycle. So if anything, it's a slight counter indicator because they don't like kitchen sinking twice. It sort of defeats the object of the word. So yes, we are circumspect about next year's earnings. We can certainly see them being under pressure. But because we've got a more sort of nuanced view around the actual risk of recession, if anything, we are thinking that any dip, certainly into the sort of mid to upper 3000s in the S&P, is likely to meet some quite significant buying pressure.
Okay. Thanks for the clarity, John. I suppose related to that, where do you see short-end real yields in the US going over the medium term? I know from your longer-term forecast, you've got them kind of going positive again. But Eugene doesn't mention what he means by medium term, but I assume that's the next few years. Is it the same issue, Thushka, with inflation risk being too high in the next couple of years?
Yes, so we do have them. He says over 3 years. Yeah, we do have them moving positive. So by the end of 23, we have the nominal rate, the Fed around 5.25. Now inflation forecast 3.7 or so. So yeah, above 1.5%. But essentially, real rates being positive, and essentially the thought process there is that the Fed has not ended a hiking cycle without having real cash rates being positive and above 1%. So where do we see that level? Yeah, between 1 and 1.5% over the next year. Over 3 years is harder. It's much harder to have an intermediate term forecast. It does depend on your recession probability and pathway, and it's more pathway dependent. But if I think about that 1% being a sort of a neutral real rate in the short term, and then using our real GDP forecasts for the long term, so 1.6% for the US real GDP there as another proxy for what neutral would look like in real terms over the medium term. Somewhere in between those two would be my expectation. 3 years is the complicated one. It depends on your pathway to recession. I think John mentioned this earlier. We are circumspect over the next few months, but a question we also get asking ourselves is what type of recession we would be dealing with, and we're not likely, in our view, to see a very drawn out balance sheet driven type of recession where you see impaired assets that prevent the recovery. We're more likely to see an income side sort of a recession which does not last or persist as long. So on average over 3 years, seeing real rates close to that 1% in positive territory looks reasonable.
Thanks, Thushka. I know we're running out of time quickly here. If I can just squeeze in 2 more questions. I just want to leave the last question around South Africa. But just this question around the stars, and I know you had some factor work in your papers. around the value versus growth cycle? And do you see value potentially continuing to outperform growth next year?
Well, it's worth bearing in mind that it depends how you cut or how you slice and dice value. What we've seen is sectors with a value signature have done very well this year. So notably energy, and of course then wider resources, and of course the financials have actually held up. It's certainly in the US, reasonably well, because by and large, as interest rates have gone up and we haven't seen big default cycles, then the banks have done okay. More volatility means more trading revenue. Although, to be fair, they've taken a hit on the other side in terms of the primary market activity, but net interest margins have been good. So I think by and large, financials, energy, resources, big value signature sectors have done better. Interestingly, though, if we translate back and look at value risk premium, when we sector and size neutralize, and we look to actually extract out the risk premium associated with the value style, actually that's as high as it ever was. And so in this year's LTCMAs, value continues to look like a very attractive investment. And as my quant team, as my quant team under Yas Ramahi, continue to tell us when we meet with our PMs, the shifts in valuation, shifts in value, shifts in risk premium for factors take multiple years to play through. So keeping that sort of residual exposure to value, certainly on the LTCMA standpoint, looks reasonably well justified.
Great, thanks, John. I know we've run out of time, but just the last question, because I looked at your forecast for South Africa and I found, the long-term real GDP of around 2.1 and inflation around 5.5. I don't think are way off from what we see domestically as well. Even though the central bank's trying to target probably 4.5 for inflation in the long run. A lot of positive things about South Africa and the younger population and institutional strength. People should read your report on that. I think it was quite an eye-opener for me. But the one I wanted to ask you on was the rand. It seems like your long-term depreciation is around 1% this year, 1% per year for the next 10 to 15 years, which I think is a lot lower than most locals would expect. And I know your number was closer to 3.5% last year. And you speak about your concerns about the dollar being overvalued. So again, I just want to get your sense for how, not necessarily confident, we know how difficult currency forecasts are, but that 1%, your feeling around that from your team that produced those numbers, it does seem highly positive from a local perspective.
Thanks, Warren. Yes, as you say, we brought down the depreciation. We're still expecting the rand to weaken over our forecast horizon. When we think about the drivers for our EM forecast, we start with the DM model, which is a PPP adjusted framework where we look at inflation differentials over the medium term, adjust for current fair value according to our estimates of fair value. So that's a DM framework. But what we add on top of that is what we call the demographic sort of dividend in a way, which is that population growth or productivity assumption that we're making. And so that's the benefit, that's the improvement that we're getting for South Africa, is the relative improvement in the per capita GDP assumption. Now, when you asked about confidence levels there, I think that increase in our inflation number for South Africa is the main contributor to the depreciation view, but the magnitude, I would agree with you, there is uncertainty around that, and clearly the political environment today will affect the near term outlook. But essentially, that the depreciation is still a key. It's still expecting the rand to weaken, but the reason for that relative improvement is essentially that demographic dividend story, or improvement in productivity over the medium term.
Okay, great, thanks, Thushka. Let's hope you're right. Even in the long run, we need it.
Yeah, that would be good.
Exactly.
Yeah.
Okay, guys, that's it for today. Sorry for running over, but I think they were useful questions to go through. Thanks for all the audience participants and all the questions. I thought that was great. Thanks to Thushka and John again for your time. We know it's valuable, and we do appreciate it. Just to wish everyone well over the festive season and safe travels if you are going away. And we look forward to seeing you in the new year with our various engagement plans, and hopefully get Thushka and John out here to South Africa in person, and we can have road shows again. That would be a wonderful outcome, I'm sure, for all of us. So all the best for the new year. Let's hope it's an easier one than this year. Cheers.